All right, so let's dive right into this deep dive, shall we?
Mm-hmm.
Today we're going to be tackling something that's super important for all of you FDIC examiners out there.
Oh, absolutely.
It's Part 337
Yeah.
of Title 12, the Code of Federal Regulations,
Right.
which you probably know as unsafe and unsound banking practices.
Exactly.
But we really want to zero in on, like, the fine print,
Oh, for sure.
the really specific wording that matters.
Yeah.
Because this is all about your technical examinations.
It is. That's a great point.
It's not enough to just know the concepts.
Right.
You've got to know this regulation inside and out.
You really do. You've got to know it backwards and forwards.
So, are you ready to get into it?
I'm ready. Let's do it.
Okay, great. So let's get down to business.
Right.
Section 337.1 kind of sets the stage.
Yeah.
It talks about identifying and addressing practices that could put the safety and soundness
Right.
of insured state non-member banks at risk.
Okay.
Can you unpack what safety and soundness really means, like in the real world of an FDIC examination?
Yeah. I mean, safety and soundness is like the bedrock, right? It's all about making sure that banks are operating in a way that protects depositors, protects the whole financial system.
Mm-hmm.
So we're talking about practices that might increase risk, could lead to financial losses,
Yeah.
or even violate the law.
Yeah.
And your job as an examiner is to like spot those red flags.
Okay, yeah. So it's not just like a theoretical thing.
No.
It has actual consequences.
Real world implications. Yeah.
Okay, so let's get into some specifics then.
All right.
Starting with Section 337.2, which is all about standby letters of credit.
Okay.
Now, these can be a little bit tricky, so let's break down the definition,
Sure.
like piece by piece.
Okay. Sounds good.
What is a standby letter of credit?
So the wording here is super precise, right?
Yeah.
A standby letter of credit is an obligation to the beneficiary
Yep.
by the issuer on behalf of an account party. It's basically a promise to pay the beneficiary if the account party doesn't meet their obligations.
Okay, so we've got like three key players here.
Yeah,
We've got the issuer, the account party, and the beneficiary.
you got it. That's exactly right.
And when would the issuer actually have to pay up?
So there are three specific situations that trigger that obligation to pay.
Okay,
Number one is the repayment of money borrowed by the account party.
okay,
Number two is payment on any debt that they've undertaken.
okay.
And then number three is like any default by the account party in fulfilling an obligation.
So it's like a safety net.
It is. It's a guarantee that kicks in if things go south for the account party.
Okay, so the definition also mentions like similar arrangements.
Right.
What would fall under that umbrella?
Okay, so think of it like this.
Okay.
A company wants to lease some expensive equipment.
Mm-hmm.
They might ask their bank to issue a standby letter of credit guaranteeing their lease payments.
Okay.
So if the company misses a payment, the equipment owner can go right to the bank and demand payment.
Got it. Got it.
That's your classic standby letter of credit.
Okay. Classic example.
Now, a similar arrangement could be something like an acceptance,
Okay.
where the bank agrees to pay a certain amount at a future date if certain conditions are met.
Mm.
So it's like a promise to pay.
Right.
It functions a lot like a standby letter of credit.
So the name might be different, but it's really the underlying obligation.
Exactly. The underlying obligation is what really matters.
Okay, so Part 337 puts some restrictions on these standby letters of credit, though, right?
It does, yeah.
Like what?
So when you're applying loan limitations,
Mm-hmm.
you have to combine standby letters of credit with all other outstanding loans
To that same borrower.
to that same borrower.
Okay, so it's not just about the individual loan, it's
Right.
about the overall risk.
It's about getting the full picture of the bank's exposure to that borrower.
Okay, are there any exceptions to that rule?
There are a couple.
Okay.
So the first one is if the bank receives full upfront payment for the standby letter of credit. Okay.
So they've already been compensated for that potential risk.
So they're covered.
Exactly.
Okay. And what's the other exception?
The other exception is if the bank sets aside enough money in a segregated account
Mm-hmm.
to cover the full amount of their potential liability under the letter of credit.
So they've got the money set aside just in case.
Exactly. It's all about mitigating that risk.
Got it. So those are the two scenarios where the combination rule doesn't apply.
Right.
But as an examiner, what are like the key things you're looking for when you come across these standby letters of credit?
So documentation and transparency,
Very
those are
straight.
super important.
Mm-hmm.
Banks have to keep very detailed records of all their standby letters of credit,
Okay.
just like they would for regular loans.
Okay.
This lets you, as the examiner, assess their potential liability
Mm-hmm.
and make sure they're complying with Part 337.
So it's all about the paperwork.
It really is.
Okay. And what about the transparency part? So these letters need to be accurately reflected in the bank's financial statements.
Okay.
No hiding anything.
No funny business.
No funny business.
Okay, so clear and accurate reporting.
Absolutely.
Got it. Okay.
Yeah.
Let's move on to section 337.3.
Right.
This is about limits on extensions of credit to bank insiders.
Yeah, okay.
I have a feeling this is where things get a little bit more complicated.
Yeah, this is where we have to really start paying attention.
Yeah.
So this section incorporates the restrictions from Regulation O, which is overseen by the Federal Reserve.
Okay.
And it's all about preventing conflicts of interest.
Yeah.
Making sure that bank insiders aren't getting, preferential treatment.
Right.
We want everything to be above board.
So we're talking about loans to bank executives, directors,
Yeah.
principal shareholders, anyone who has a lot of influence.
Anyone with significant influence, exactly.
What are the specific limits that examiners need to be aware of?
Okay, so Regulation O sets limits based on the bank's unimpaired capital and surplus.
So for any individual insider, the total credit extended can't exceed the greater of $25,000
Okay.
or 5% of that unimpaired capital and surplus.
Okay.
Now, there's a higher limit of $500,000, but that comes with some extra requirements.
Hold on, let me make sure I've got this straight.
Sure.
There's like a baseline limit,
Right.
but it can go higher if certain conditions are met.
Exactly. To go up to that $500,000 limit, the transaction has to be approved beforehand
Okay.
by a majority of the bank's board of directors.
Got it.
And the insider who would benefit from the loan can't vote on that approval.
So there are safeguards in place.
Yeah, it's all about preventing self-dealing.
Makes sense.
Right.
Now, what about situations where you've got a bank executive who's involved in a partnership?
Right.
Does that change things?
It definitely complicates things.
Yeah.
When an executive officer is part of a partnership that gets a loan from the bank,
Yeah.
the rules get a little more complex.
The total credit to the partnership is considered to be extended to each executive officer involved.
So you're looking at their total exposure.
Exactly. Not just the individual loan. It's
Yeah.
about aggregating their credit exposure.
It's like a loophole they're trying to get through.
It is. It's a clever way to prevent them from circumventing the rules.
Right.
And it's important to remember those definitions from Regulation O.
Yeah.
Like what constitutes an executive officer, those carry over to Part 337.
So we're building on those definitions.
Exactly.
Okay, before we move on, Section 337.3 uses the term FDIC supervised institution.
Right.
Is that just another way of saying insured state non-member banks?
It's a little bit broader than that.
Okay.
FDIC supervised institution refers to any entity for which the FDIC is the primary federal regulator.
Okay.
So that could include certain savings associations
Right.
or other financial institutions under the FDIC's umbrella.
Got it. So it's important to pay attention to those little differences in wording.
It is. Those little distinctions can be really significant.
Yeah, they can. They can change the meaning.
Absolutely.
Okay, so we've covered the scope, standby letters of credit,
Right.
and loans to insiders. That feels like a pretty solid foundation for understanding Part 337.
Yeah, we're making good progress, and don't worry, we'll have time to review
Okay.
and quiz ourselves later on.
That's reassuring. I was getting a little nervous.
Don't worry, we'll make sure you've got it all down.
Okay, good.
Yeah.
Now I'm noticing that Section 377.4 is completely reserved.
Oh, yeah.
Why is that?
Sometimes regulations evolve
Yeah.
and sections get reserved for future use.
Oh,
It could be that the FDIC is planning to address another specific banking practice down the line.
okay.
Or maybe they're just leaving some room for flexibility.
Yeah, you got to stay agile.
Exactly. Regulations aren't static. They adapt to new challenges,
They do.
new risks.
Okay, well, let's move on to Section 337.5 then.
All right.
This one focuses on exemptions. Are there situations where the rules we've talked about so far don't apply?
There are a few specific exemptions.
Okay.
One notable exception is for check guarantee card programs
Oh, yeah?
and similar arrangements.
Mm-hmm.
These programs allow customers to guarantee checks or transactions up to a certain limit.
Okay.
It's a form of overdraft protection.
So even though the bank is essentially guaranteeing the customer's obligations,
Right.
it doesn't fall under the same restrictions as a standby letter of credit.
Exactly. As long as the bank assesses the customer's creditworthiness before enrolling them in the program.
Okay.
That individual assessment is key.
Yeah.
It helps manage the risk.
So it's like a balance between convenience for the customer and risk management for the bank.
You got it. It's finding that balance.
Right.
And even with this exemption, Any arrangement involving the bank's principal shareholders,
Mm-hmm.
directors, or executive officers still needs to comply with Regulation O.
Of course, we can't forget about Regulation O.
Nope, those insider rules always apply.
Right, right.
They're kind of a constant theme.
Okay, now let's move on to Section 337.6, which deals with brokered deposits.
Right, this is a big one.
This one seems especially relevant for the examiners,
Yeah.
as it can be like a red flag for potential problems.
Absolutely, you're right.
So let's break it down.
Okay.
What exactly constitutes a brokered deposit?
So the definition really hinges on the involvement of a deposit broker,
Okay,
which is very specific. It's
Yeah.
not just anyone who helps someone open a bank account.
right. So who qualifies as a deposit broker?
Okay, so there are 4 categories.
Okay.
First, anyone engaged in the business of placing deposits from third parties
Okay.
with insured depository institutions.
Okay.
So someone who's actively seeking out deposits and directing them to specific banks.
Got it. So they're like a middleman.
Exactly, they're the matchmaker.
Okay, what's the second category?
Second is anyone engaged in the business of facilitating the placement of those deposits.
Okay.
So this could involve negotiating rates, fees, or other terms of the deposit accounts.
So they're not like handling the money directly,
Right.
but they're involved in the process.
They're playing a key role. Yeah.
What's the third category?
The third category is about individuals or entities placing deposits with the intention of selling those deposits or
Yeah.
interests in those deposits to third parties.
So they're like buying and selling deposits.
They're acting as middlemen for profit.
Okay, and what's the fourth category?
Fourth category involves an agent or trustee who establishes a deposit account
Mm-hmm.
to facilitate a prearranged loan
Okay.
with an insured depository institution.
So they're using the deposit as like collateral or something.
Exactly, as a funding mechanism for a loan.
Got it. And the regulation clarifies what engaged in the business means.
Right. It's not a one-time thing. It's
Sure.
a pattern of activity, multiple institutions, third-party funds.
Okay, I think I'm getting a little fuzzy on the difference
Okay.
between engaged in the business of placing deposits and engaged in the business of facilitating.
Yeah, it can be a little tricky.
Can you give me an example?
Sure. Imagine a financial advisor who recommends specific banks to their clients
Okay.
based on their needs, the bank's offerings.
Mm-hmm.
That advisor is facilitating the placement of deposits, connecting clients with banks,
Right.
but they're not directly handling the funds.
Okay.
Now contrast that with a firm that solicits funds from investors, pools those funds, and then deposits them in various banks to get the highest interest rates.
Okay.
That firm is directly engaged in the business of placing deposits.
Right.
They're managing the flow of funds.
Okay, that's a really helpful example.
Good, I'm glad that clarifies it.
Yeah, it does. It does.
Yeah.
Are there situations where someone might seem like a deposit broker but isn't?
There are several exceptions outlined in the regulation.
Like what?
So, for example, an employee of an insured depository institution
Mm-hmm.
isn't considered a deposit broker when handling deposits for their own institution.
Okay, yeah, that makes sense.
Yeah, it's about recognizing legitimate activity
Right, right.
within the bank's normal operations.
Okay, what other exceptions should examiners be aware of?
The regulation excludes certain types of trust accounts,
Okay.
pension plans, government programs, as long as their primary purpose isn't to place funds with depository institutions.
Okay, so it's about understanding the intent.
Exactly, the primary function of the arrangement.
So once we've identified a broker deposit, then what?
All right, so the restrictions depend on the bank's capitalization level.
Okay.
Well-capitalized institutions have the most freedom.
Okay.
They can solicit and accept brokered deposits without restrictions.
They're good to go.
They're good to go. They're considered to be in a strong financial position.
Right.
They can handle the potential risks.
Okay, what about adequately capitalized institutions?
So for adequately capitalized institutions, things get a bit tighter.
Okay.
They can only accept, renew, or roll over brokered deposits if they've gotten a waiver from the FDIC.
Okay, so there's an extra layer of oversight there.
Exactly. It's about managing that risk.
Okay, and what about undercapitalized institutions?
Undercapitalized institutions face the most stringent restrictions.
Okay.
They're actually prohibited from accepting, renewing, or rolling over any brokered deposits.
Okay, so that's a pretty clear line.
It is. The FDIC sees these institutions as being in a more precarious position, and accepting brokered deposits could really increase their risk profile.
Okay, so you mentioned that adequately capitalized institutions can apply for waivers.
Right.
What does that process look like?
So it's a case-by-case process.
Okay.
An adequately capitalized institution can apply.
Mm-hmm.
The FDIC will review their application.
Okay.
They'll consider factors like the institution's overall financial health, management quality,
Okay.
the specific terms of the brokered deposits they're seeking to accept.
Yeah.
They're really trying to determine if accepting those deposits would pose an undue risk.
Right, to the institution or the insurance fund.
Exactly.
So it's not just a rubber stamp.
No, it's a thorough evaluation.
And if the FDIC grants a waiver, can they take it back?
They can, yes.
Oh.
If they determine that the institution's condition has deteriorated,
Oh.
or if accepting brokered deposits is no longer considered safe and sound.
So they're constantly monitoring.
Absolutely. Always adjusting as needed.
Okay, are there any other special cases related to brokered deposits that examiners should keep in mind?
Yeah, there's a limited exception for reciprocal deposits,
Okay.
which are agreements between banks to place deposits with each other.
Mm-hmm.
This applies when the total amount of reciprocal deposits doesn't exceed certain limits,
Okay.
and the bank placing the deposits meets specific criteria, like having a good supervisory rating,
Okay.
being well capitalized.
So some interbank deposit arrangements are seen as less risky.
Right. But this exception only applies up to a certain point.
Got it.
Once that threshold is exceeded, those reciprocal deposits become subject to the regular brokered deposit restrictions.
So even within these regulations, there are always like little details and nuances.
Always, it's about understanding the context, applying the definitions carefully,
Right.
and using your judgment as an examiner.
Absolutely. Well said.
Okay.
We've covered a lot of ground on brokered deposits.
Okay.
Ready to move on to section 337.7.
Let's do it.
Okay, this one deals with interest rate restrictions.
Right.
Now, this might seem a little simpler on the surface,
Yeah,
but I'm sure there are some intricacies we should explore.
you're right. There are definitely some key definitions and rules we need to understand.
Okay.
Let's start with the concept of the national rate.
All right, national rate. What exactly is that?
So the national rate is a benchmark rate for specific deposit products.
Okay.
It's calculated by the FDIC.
Okay.
They take the weighted average of rates paid by all insured depository institutions and credit unions
Okay.
on that particular product.
So it's like a nationwide average.
Exactly, taking market share into account.
And why do we need a national rate?
So it serves as the foundation for the national rate cap, which is a ceiling on the interest rate certain banks can offer on specific deposit products.
Okay, so there's a limit on how high those interest rates can go.
There is. It's designed to prevent certain banks from offering rates that are too high.
Okay, how is that national rate cap calculated?
So it's the higher of two values,
Okay.
the national rate plus 75 basis points,
Mhm.
or 120% of the current yield on similar maturity U.S. Treasury obligations,
Okay.
plus 75 basis points.
So it's tied to both the national rate and what's happening in the Treasury market.
Exactly. It takes both of those factors into account.
Okay, and why the 75 basis points in both cases?
Those 75 basis points give banks some flexibility to offer competitive rates,
Okay.
recognizing that they have operating costs
Yeah.
and need to make a reasonable profit.
Right, makes sense.
Yeah,
You mentioned that this national rate cap applies to certain banks.
right.
Which ones are we talking about?
It primarily applies to institutions that are not well capitalized.
Okay.
It's meant to prevent them from engaging in risky behavior.
Like offering super high interest
Yeah.
rates just to attract deposits when
Exactly.
they might not be in the best shape.
Exactly, when their financial condition might be a little shaky.
So it's a protective measure.
It is for both the institution and the deposit insurance fund.
Now, is the national rate cap the only restriction on interest rates?
There's also a local market rate cap
Okay.
that institutions can choose to use instead.
So there's an alternative.
There is. It's based on local conditions.
Okay, how does that one work?
So the local market rate cap is set at 90% of the highest interest rate paid
Right.
on a particular deposit product in the institution's local market area.
Okay.
So instead of looking at the national average,
Yeah.
they can focus on the competition in their specific region.
Right.
It gives them a little more flexibility.
So how is local market area defined?
It can be any readily defined geographical area
Okay.
where the institution accepts or solicits deposits.
Okay.
So this could be a state, a county, a metropolitan statistical area. It depends on the institution's reach.
So if a bank wants to use that local market rate cap, What do they have to do?
They need to provide notice and evidence of the highest rate being offered in their local market area to the appropriate FDIC regional director,
Ugh.
demonstrating they've done their research and they understand the local competitive landscape.
And they need to keep that information updated, right?
Yes, they need to update their calculations monthly
Okay.
and keep that documentation for examination purposes.
Makes sense.
The FDIC wants to make sure they're staying on top of any changes
Right.
in local market conditions.
So ongoing monitoring and reporting.
Absolutely.
Okay, what about those situations where an institution wants to offer a product
Right.
with like an unusual maturity period that's not explicitly covered by the national rate cap?
Right. So that's where we get into on-tenor and off-tenor maturities.
Okay, on tenor and off tenor, what's the difference?
So on-tenor maturities are the standard periods for which the FDIC publishes national rate caps.
Okay.
So like 1 month, 3 months, 6 months, and so on.
Yeah, okay.
Off-tenor maturities are any other periods.
Okay, got it.
So if a bank wants to offer a product with an off-tenor maturity, they have to use the rate offered on the next lower on-tenor maturity.
So for example?
For example, if they want to offer a 26-month certificate of deposit, they would use the national or local rate cap for a 24-month CD.
Got it. Keeps things consistent.
Exactly.
Are there any special considerations for non-maturity deposits?
Yes, non-maturity deposits like savings accounts or money market accounts.
Okay.
They're treated a bit differently.
Okay.
The regulation defines solicitation of these deposits, which includes things like opening a new account, raising the interest rate on an existing account, or crediting funds from a new depositor to an existing account.
So even seemingly small changes
can trigger those interest rate restrictions.
Got it. Okay.
Yep.
We've talked about the national rate cap and the local market rate cap.
Right.
But is there ever a situation where those caps might be adjusted or delayed?
The FDIC does have the authority to delay the effective date of a published national rate cap.
Okay.
If they believe a substantial decrease could disrupt the market. So this flexibility lets them respond to changing economic conditions.
That's good. The regulations can adapt.
They have to, yeah.
Now let me put on my examiner hat for a second.
Okay.
If I'm looking at an institution's deposit products and trying to figure out if they're violating the interest rate caps,
right?
How do I do that?
All right. So first you determine the institution's capitalization level.
Okay.
If they're well capitalized, they're not subject to these restrictions. You can move on.
Got it.
But if they're adequately capitalized or undercapitalized, you need to figure out if they're using the national rate cap or the local market rate cap.
Okay.
If it's the local market rate cap, make sure they've given the required notice and documentation to the FDIC.
Right. First step done. What's next?
Then you gather information on the interest rates they're offering on their various deposit products, including the maturity periods.
Okay.
Compare those rates to the applicable national or local rate cap.
Got it.
If they're exceeding the cap, you investigate further and see if any exceptions or waivers apply.
So it's a systematic approach.
It is.
Gather information, compare it to the regulations, and follow up on any discrepancies.
Exactly. And clear documentation is essential throughout the process.
Okay.
You need to be able to back up your findings.
Always document. Got it.
Always document.
Okay. We've covered a lot of ground on interest rate restrictions.
We have.
It's a good reminder that even seemingly simple regulations can have layers of complexity.
They really can. And as we continue, remember that Part 337 is dynamic.
Okay.
Can be amended or reinterpreted by the FDIC.
Yeah, it's not enough to just learn it once.
Yep.
You've got to stay updated.
Absolutely stay informed.
Okay. Well, I'm curious to see how much of this has sunk in.
Oh, I'm
ready for a pop quiz.
Bring it on. Let's see what you've got.
All right. First question.
Okay.
This one requires you to think back to our discussion on standby letters of credit.
All right.
What are the 3 potential triggers for a bank's obligation under a standby letter of credit?
Okay. The 3 triggers are repayment of money borrowed by the account party, payment on any debt they've taken on, and any default by the account party in fulfilling an obligation.
Perfect. You got it.
All right.
Okay. Now for a true or false question about broker deposits.
Okay.
An adequately capitalized institution can freely accept any brokered deposit without restriction. True or false?
That's false.
You're on roll.
Adequately capitalized institutions need to obtain a waiver from the FDIC.
You got it.
Before they can accept, renew, or roll over brokered deposits.
Okay, last question.
Okay.
Let's dive back into those interest rate restrictions.
You're right.
What are the two components that go into calculating the national rate cap?
Okay, so the national rate cap is the higher of the national rate plus 75 basis points,
Okay.
or 120% of the current yield on similar maturity U.S. Treasury obligations plus 75 basis points.
You aced the quiz. 3 for 3.
Wow.
Looks like this information is starting to stick.
I'm impressed. You've been a great student.
Oh, thank you.
And remember, even though these regulations can be dense, they're incredibly important for the stability of our banking system.
Absolutely. Understanding these details empowers examiners to conduct thorough and effective technical examinations.
Exactly.
Yeah.
And one final thought.
Yeah.
Remember that Part 337 is dynamic. It's subject to change.
Right.
So always stay updated. So always stay updated on any revisions or interpretations issued by the FDIC.
Great advice. We'll be sure to keep our listeners in the loop about any major changes.
Wonderful. I'm confident that with this knowledge, you'll be ready to tackle your next technical examination.
I agree. Thanks for joining us and sharing your expertise.
It's been a pleasure.
Now, let's take a moment to revisit some of the key points we've discussed today.
Okay.
Just to kind of solidify your understanding.
Sounds good to me. Repetition is key for mastering these details.
Absolutely. So let's start by revisiting the importance of safety and soundness in the context of Part 337. I mean, it's really the core principle guiding your work as FDIC examiners, right?
It is. Yeah, it's not just about checking boxes, you know?
Yeah.
It's about really understanding how a bank's practices can impact its stability and the broader financial system.
Yeah.
It's about identifying risks, mitigating potential losses, and preventing violations.
Exactly. And we talked about how standby letters of credit play into this.
Yes.
Those three key players.
Yeah.
The issuer, the account party, and the beneficiary.
Right.
And those specific triggers for the issuer's obligation.
Yeah, those are essential to remember.
They are. And don't forget those similar arrangements.
Oh, right. Yeah.
It's not just about the name. It's about recognizing that underlying obligation
Absolutely.
that the bank is taking on.
Yeah. Yeah. Good point.
We also talked about how those standby letters of credit are treated when applying loan limitations.
Yes.
That combination rule is designed to provide a complete picture of a bank's exposure to a single borrower.
Yeah, we don't want them concentrating too much risk in one place.
Exactly. And then there are those two exceptions.
Right.
Full upfront payment or a segregated account to cover the potential liability.
Yeah, those are important to remember.
Very important. And of course, thorough documentation is key.
Always.
Examiners need to see those clear records of all standby letters of credit.
Right.
And those letters need to be accurately reflected in the bank's financial statements.
Yep. Transparency is key.
Transparency is key. Okay.
Yeah.
Now, let's shift gears and talk about loans to insiders.
Right.
This is where Regulation O comes into play.
Yes.
And those specific dollar limits based on unimpaired capital and surplus are really important.
They are. Yeah, you've got to know those limits.
And remember that higher limit of $500,000,
right,
but also those additional requirements,
yes,
board approval, and the insider abstaining from voting.
Right. Those safeguards are there to prevent conflicts of interest.
Absolutely. And examiners need to be especially careful when dealing with partnerships.
Oh, yeah.
Involving bank executives. Remember, it's about aggregating their credit exposure across all their related interests.
Exactly. You got to look at the big picture.
And don't forget that those definitions from Regulation O, like executive officer, carry over directly to Part 337.
They do. They do.
That's right. Now, let's talk about those exemptions outlined in Section 337.5.
Okay.
Check. Guarantee card programs are a good example.
Yeah, good example.
Even though the bank is guaranteeing the customer's obligations, those programs are exempt from the same restrictions as standby letters of credit.
As long as the bank conducts a thorough creditworthiness assessment beforehand.
It's all about balancing that convenience for customers with risk management for the bank.
Yeah, finding that sweet spot.
And remember, even with this exemption, those insider rules still apply.
Always. Always keep those insider rules in mind.
They're like a constant thread throughout Part 337.
They are. They're woven throughout the whole thing.
Okay, now let's tackle brokered deposits.
All right, this is a big one.
This is a big one. Those 4 categories of individuals or entities that qualify as deposit brokers are crucial for examiners to understand.
Yeah, you got to know who you're dealing with.
And that distinction between engaged in the business of placing deposits and engaged in the business of facilitating the placement is important to grasp.
Yes. Remember our example with the financial advisor versus the firm pooling funds?
Great example. Very helpful.
I'm glad.
And don't forget those exceptions, like employees handling deposits for their own institution.
Yeah?
Or certain types of trust accounts in government programs.
Right. It's about understanding the intent and purpose of those arrangements.
Exactly. Now, once we've identified a brokered deposit, those restrictions based on capitalization levels kick in.
Right.
Well-capitalized institutions have the most freedom. Adequately capitalized institutions need a waiver.
Yep.
And undercapitalized institutions are prohibited outright.
It's a tiered system designed to manage risk based on the institution's financial health.
And those waivers for adequately capitalized institutions, they're not a guarantee.
No, not at all.
The FDIC conducts a thorough review.
They do.
To assess the potential risk.
Yeah, they got to make sure it's safe and sound.
And they can revoke those waivers if circumstances change.
Absolutely. They're always monitoring.
Right. And we can't forget that limited exception for reciprocal deposits between banks.
Right. Those have their own set of criteria and limits.
It's another reminder that there are always nuances within these regulations.
Always nuances. You got to stay sharp.
Yeah. Now let's move on to interest rate restrictions.
Okay.
Those definitions, national rate cap, local market rate cap, are crucial.
Yeah, you got to know those like the back of your hand.
Remember how the national rate cap is calculated?
Oh, yeah. That's a mouthful.
It is. It's the higher of the national rate plus 75 basis points.
Right.
Or 120% of the yield on similar maturity U.S. Treasury obligations plus 75 basis points.
You got it.
And examiners need to be aware of both the national rate cap and the local market rate cap, understanding when each applies.
It's all about context.
And if an institution is using that local market rate cap, they need to have provided the proper notice and documentation to the FDIC.
Right. That documentation is key.
It is. And we talked about how to handle off-tenor maturities using the rate cap for the next lower on-tenor maturity.
It keeps things consistent.
And how even seemingly minor actions related to non-maturity deposits, like raising an interest rate or crediting funds from a new depositor, can trigger those interest rate restrictions.
It's about the details.
It is. And remember, the FDIC has the authority to delay the effective date of a national rate cap.
Right.
If they believe it's necessary for market stability.
Yeah, sometimes you need that flexibility.
Now let's step back and think about how an examiner approaches an institution's deposit products to check for compliance.
Okay, glad.
It's a systematic process, right?
It is.
First, determine the capitalization level.
Right.
Then figure out which rate cap applies. Gather information on their rates and maturities.
Yep.
Compare that information to the applicable cap. And investigate further if there are any discrepancies.
And document
everything, always.
Okay, document your findings. Be ready to support your conclusions with evidence.
We've covered so much ground today.
We have.
And it's clear that Part 337 is a complex
and
nuanced regulation.
It is.
But remember, as examiners, you're equipped with the knowledge and skills to navigate these complexities.
Absolutely. And remember, Part 337 is a living document, right?
Yes.
So always stay informed about any updates or changes issued by the FDIC.
That's crucial. Continuous learning is key to success in this field.
It is. You got to stay sharp.
Now, I'm curious. What happens if a bank is found to be violating these rules?
Ooh, okay,
Like, what are the consequences of non-compliance with Part 337?
Right. This is where your role as examiners becomes even more critical. It's not just about understanding the rules, but about enforcing them. The consequences for noncompliance can be significant. They can range from informal supervisory actions to more formal enforcement actions.
So it's not just a slap on the wrist.
No, there are real repercussions.
Okay, so let's break down those potential consequences.
All right.
So our listeners are fully aware of the range of actions that the FDIC can take.
All right, so let's start with those informal supervisory actions.
Okay, informal, so like what does that involve?
Well, one common approach is requiring the bank to submit a corrective action plan.
Okay, a plan. So what would be in that?
It would outline how they're going to address the violation.
Okay, so it's like their roadmap to get back in compliance.
Right. Exactly. It shows the FDIC that they're serious about fixing the problem.
So it's a chance for the bank to get back on track.
It is. Yeah, the FDIC wants to see banks operating safely and soundly.
Right. They're not just looking to punish institutions.
Not at all. But if those informal actions don't do the trick,
Yeah.
Or if the violation is more serious,
Okay.
the FDIC can move to more formal enforcement actions.
Okay, formal actions like what are we talking about here?
Well, one common tool is a cease and desist order.
Okay, cease and desist. That sounds serious.
It is. It's basically a legal stop doing that from the FDIC.
Well, it's like stop whatever you're doing that violates the regulation.
Exactly, and take steps to correct the violation.
So it's a more direct approach.
Yeah, it's more forceful.
Okay. And are there any other formal actions the FDIC can take?
In some cases, they might impose civil money penalties.
Oh, so like fines.
Exactly, financial penalties that hit the bank where it hurts their bottom line.
Yeah, I bet that gets their attention.
It does, and those penalties can be pretty substantial, depending on how bad the violation is.
So there's a real financial incentive to comply with Part 337.
Absolutely. Nobody wants to be writing those big checks to the FDIC.
Okay, so we've got informal actions, formal actions like cease and desist orders and fines. Are there any other tools in the FDIC's toolbox?
In those really extreme cases, where a bank's actions are considered reckless.
Reckless.
Or a real threat to the whole financial system.
Okay, like worst case scenario.
Yeah, worst case scenario.
What can the FDIC do?
The FDIC has even stronger measures they can take.
Like what? What are those?
Well, in very rare cases, they might take steps to remove bank management.
Wow, they can actually remove the people in charge.
They can if they think those individuals are putting the bank at risk.
Okay. And what else?
Or, in the most extreme situations, they might even revoke the institution's deposit insurance.
Wow, revoke their insurance. That's a big deal.
It is. It's the nuclear option, really.
Yeah, it just basically shuts the bank down.
It does, and it shows just how seriously the FDIC takes these violations.
So these consequences, they're not just theoretical.
No, they're very real, and they have a huge impact on the institutions involved.
Well, it sounds like the FDIC has a pretty comprehensive set of tools.
They do, and it's all about protecting the stability of the banking system.
And the depositors who rely on those banks.
Exactly. You're right. It's about safeguarding the public trust in our financial institutions.
Absolutely. Well, I think this has been an incredibly informative deep dive.
I agree. We've covered a lot of ground.
We've really gone through Part 337 with a fine-tooth comb.
We have. And I hope our listeners are feeling more confident in their understanding of this regulation.
Yeah, it's a lot to take in, but it's essential knowledge for anyone involved in bank examinations.
And remember, the learning never stops.
Right. The regulations are constantly evolving.
Exactly. So stay curious, stay informed, and keep those questions coming.
Well, on that note, we'd like to thank all of our listeners for joining us today.
Yes. Thank you for tuning in to this episode of The Deep Dive.
We'll be back soon with another deep dive into the world of banking regulations.
Until then, stay vigilant and keep up the great work.
And remember, you are the front line in ensuring the safety and soundness of our financial system.
Your role is crucial, and we appreciate your dedication to this important work.
Thanks again for listening, and we'll see you next time.